Today we're going to discuss overstated inventory. I'm going to show you how overstating an inventory plays out over the course of 3 years. I'm Professor Capko and I help people better understand accounting, law, math, and other subjects. So you've come to the right place if you need a better understanding of overstated inventory. But before we dive into that, I have a good feeling that something great is going to happen for you today. So let's get back to the video. Overstated inventory is where some inventory, such as an ending inventory, is taken, but it is overstated. In other words, something is double counted or the math is done wrong, something where we've recorded an ending inventory that is higher than the actual inventory that's there. So in our example we're going to work through here, an ending inventory of 400,000 is recorded, but the actual ending inventory is 300,000. So there's actually $300,000 worth of items in the warehouse to be sold to customers, but we incorrectly write down or count $400,000 worth of items. So we're going to work our way through that. I did a prior video on overstating and understating, showing how that impacted both your balance sheet with your assets and your net income because of the gross profit. If you didn't see that video, you may want to start with that. I've linked it up here. You can watch that and then come back here for a little bit deeper dive into it. So let's take a look at this. We have a net sales in year one of 950,000. Now, to make things clearer and to make it where we only have one variable and in play, I'm going to say that each of our 3 years we have the exact same net sales. And for each year, we're going to have, well, if it's actually true, we would have a beginning inventory of 300,000 and an ending inventory of 300,000 for each of those years, with a net sales of 950,000. Of course, in our example here, we're going to have the first year have an incorrect ending inventory, and we're going to see how that plays out. But every other variable is going to stay exactly the same. So we start out with our $950,000 of net sales for the beginning of that year, year one. Our beginning inventory is correct with 300,000. We add to that any purchases of items that we're going to resell, in this case $600,000. So we have goods available for sale. We add the beginning inventory and the purchases. So we have a $900,000 worth of goods available for sale to our customers. Our incorrect ending inventory in this case is $400,000. Remember, it should be 300,000, but because of the error, it's 400,000. So I'm going to take our goods available for sale, the 900,000, and I'm going to subtract from that our incorrect. Again, we don't know that it's incorrect at the time, but we know it now. Our incorrect ending inventory of 400,000. That means we have a cost of goods sold of 500,000. If our cost of goods sold is 500,000, we subtract that from our sales of 950,000, and that gives us a first year gross profit of $450,000. We're going to take that incorrect ending inventory and put it as our beginning inventory for year two. The reason is for example, if it's a calendar year company, we would take that ending inventory conceivably on December 31st, and that would be our beginning inventory for year two. We don't go and re-inventory everything on January 1st. We just take the ending inventory from last year and we use it as the beginning inventory for the following year. We're going to take that beginning inventory, which we know now is incorrect, but at the time we don't know, the 400,000, we're going to add to it our $600,000 of purchases. So we have goods available for sale of $1 million. At the end of the period, we take the inventory again. At the end of the year, we take the inventory again, and this time we correctly get 300,000. So I'm going to subtract that 300,000 from our $1 million worth of inventory available for sale, and that gives us a cost of goods sold of 700,000. Our 700,000, I subtract that from our sales of 950,000, and that gives us a gross profit of 250,000. Now we're going to take this correct ending inventory and we're going to use it as our beginning inventory for year 3. I'm going to take our beginning inventory for year 3. I'm going to add it to our purchases for the year, which is again the same $600,000, and that gives us goods available for sale of $900,000. I'm going to subtract from that our correct ending inventory in year 3 of $300,000, and that gives us a cost of goods sold of $600,000. I go ahead and subtract the cost of goods sold from our sales figure for year 3 of 950,000, and that gives us a gross profit of 350,000. What I want to do is see how this worked out for the 3 years. So if I take them and I'm going to add up the 3 years of profit. So I have the 350,000. I'm going to add to that our 250,000 from year 2, and I'm going to add to that our 450,000 from year 1, and we have a total gross profit for 3 years of $1,050,000. I want us to keep that in mind because that's the 3-year total with the incorrect ending inventory the first year. So far, if you're finding this type of material helpful, go ahead and smash the like button. That will really help us with the YouTube algorithm. Let's compare that to doing everything correctly. On this sheet, we actually do everything correctly, and that's going to show us what our profit is. So in this case, we're going to have the same 950,000 sales for each year. Our beginning inventory is correct for each year. Our purchases are the same. Our goods available for sale is the same. Our ending inventory is done correctly here. So that means our cost of goods sold is 600,000 each year. So each year our gross profit is 350,000. If I take that and let's see what we wind up with. If I have 350,000 of gross profit for 3 years, that gives me a gross profit for the 3 years of $1,050,000, which was the same amount we had with the incorrect amount for the ending inventory for year 1. So what we have learned from this is if everything else is correct, then at the end of 3 years, we do wind up with the correct amount of gross profit. So the problem corrected itself over the course of 3 years because we only had one mistake, and that was in the first year ending inventory. Hopefully that makes sense to you. Go ahead and watch this again if it doesn't, because we've covered a lot of numbers here, but they're all done the same way. If you have any questions or if you have other problems you want us to work out, put it in the comments below, and hopefully this will help you understand overstating and understating inventory. The same thing would have happened if we had understated the inventory in the first year 3 years later, it would work itself out. So keep your grade alive and subscribe. Thank you.